Okay, everything's green, that's fine. And then we'll look at GameStop. We're up 75% today. This was a play I made 2 months ago, and now is coming into fruition. The strategy I used was selling a naked call option. Let me explain. How's it going, mindful investors? In this video, I'm going to talk about my GameStop case study and how I made 75% in one day. Let's get to it. So here's a little backstory on GameStop. GameStop is a retailer here in North America that specializes in selling games. There are EB Games in Canada and GameStop in the US. And then if we look at the ticker symbol GME GameStop, the chart shows that they peaked in 2013 at about $54 right here. And then it trended all the way down and down and down. It went from 55 and down to possibly, I think, around $4. Yep, around $4. 55 to $4 in about 6 years. And that's because back then in 2013, their main source of revenue was buying used games from the customers and reselling them at a higher margin. So this is how it goes. A kid brings like a stack of games, maybe 10 or 15 older games that they're done with. They bring it into GameStop and then one by one they scan it into the system and they say, oh, this one is worth $2, that one maybe $5, $3, and so forth. By the end of it, they say, oh, so this stack of games will give you $45 for it. They're not giving you cash. They're giving you store credit. You then have to spend the money in the store, which generates some more profits. So that engine runs perfectly back then. And they were also the main source when it comes to buying games and new systems. Everyone would just line up at the malls and buy these new consoles and games and accessories and so forth. But fast forward 5 years, we're in a completely different game here. The bread and butter of reselling used games is out of the question. Because right now, 80% of the gamers are just buying the games online. They just turn on the console and click, 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 and then it's done. They don't even have to get off the couch. So this core business is completely done. If you visit one of their stores right now, it's like a scrapyard. There's still a little section for gaming, but then when you walk around, you see little plushies, figures, stickers, even t-shirts. They're like a mini version of Toys R Us. And we all know what happened to Toys R Us. They went bankrupt. Then we have the second source of revenue, selling games and consoles. And as we know, that story has changed as well. Right now, we just click on Amazon and Best Buy, and then next day we have it at our doors. Any accessories, any memorabilias, we can find it there. Why do I have to go to the shop? So all of this was my thesis of shorting the stock. Okay, so now onto my naked call option strategy. I didn't just go in randomly and do it. You have to pick your spots. You have to pick when the premiums are extremely high. And that was caused by a news article back in October. That looks great on the surface, but if you dig down a little bit, you realize that it's pure BS. The tagline for the article was that GameStop partnered with Microsoft, and it caused the stock to jump 20%. And that is when I made this play. Let's dig a little bit deeper, shall we? Okay, here's my options contract for GameStop when I made the play. It was these huge jumps that made the stock go from $10 to $20. I made the play around this area, $1.26, $1.30. It did continue to go up to about $1.74, and then it tapered right back down because everyone realized it's BS. But over time, they made a couple more peaks, even here at $2.70. And what my play was back in October, I didn't make the play for the extreme short term, like weeks. I made it for a 3-month time frame in January 15th, right here. And there's a reason for that, because I know they report earnings in December, and that would fully reflect on this Microsoft partnership. When I dug in the article, I see that they're just partnering in the operating system. Like GameStop was using the OS, like Windows, and the point of sale system, and their Outlook email. Like none of this can drive sales, in my opinion. So this earnings really reflected all that this partnership didn't matter. And the stock dropped 20% today, therefore my options play worked. It still has another month till expiry. I'm just gonna let it run out because right now the stock is at $14.4 and it has to jump above $30 for me to be in the red. But technically, it has to be even higher than that because when I sold the option for $1.31, I've collected the premiums already. So the break-even point is actually 30 plus $1.03, $31.30. If it stays under 31.30, my whole play would capitalize and I get 100%. Again, these naked calls are really dangerous. I could have implemented the bear call spread instead to cap my potential losses. But that really depends on how much conviction you have on the play. I made the bear call spread on Tesla because I know anything can happen with that stock. The amount of hype on Tesla is to the moon. I wouldn't be surprised if it jumped 10-20% in a day. We've seen that many times this year. And then some of you in the comments have mentioned why I would short call instead of doing a long put. Well, these are completely different strategies, and we'll discuss it in a later video. But the gist of it is that when I do a short call, I'm betting that something wouldn't happen. When you do a long put, you're betting that exact thing will happen to that exact magnitude before a certain date. By betting something wouldn't happen, in my opinion, my chance of winning is 90+%. While if you bet something will happen, I think the chance of winning is like less than 20, less than 10. Another reason why I went for the short call instead of just straight up shorting the stock, because I've actually done that for the past couple years. I shorted the stock at around 2-3 years ago at around $25. I shorted them all the way down to $5. But there was an issue with that. I didn't make much money because back in 2017 to 2019, that's a gap of 2 years, and there's a cost of shorting a stock. You have to borrow the shares of someone off the platform. For this volatile stock, it was 40% per year. So even when the stock dropped from $25 to $5, an 80% drop, because the cost of borrowing is 40% per year just to short the stock. So that's why I don't short stocks anymore. I do short calls, bear call spreads, or long puts to mitigate this interest problem. So what do you think about this GameStop case study? We can apply a couple of these basic principles to other stocks as well. Like and subscribe to the channel if you found any value in the video. Thanks again for watching, and I'll see you in the next one.